From 1980 to 2023, the real inflation-adjusted price of gold provided a return of just over 1% per year. The real inflation-adjusted price of crude oil was negative. Unlike stocks, which are a claim on human ingenuity, or bonds, which are a claim on productive enterprise, commodities do not grow. They do not innovate. They do not produce earnings. They are simply raw, physical inputs. To invest in them is not to bet on progress, but to bet on scarcity, fear, and the fundamental building blocks of the global economy. In the next 10 minutes, you will learn exactly what a commodity is, understand the powerful and violent forces of supply and demand that govern their price swings, and discover the specific, strategic role these volatile assets can play in a sophisticated investment portfolio. A commodity is a basic good or raw material that is interchangeable or fungible with other goods of the same type. This concept of fungibility is the key. One barrel of West Texas Intermediate crude oil is, for all practical purposes, identical to any other. One bushel of grade 2 yellow corn is the same as the next. This is the direct opposite of a company like Apple or a specific piece of real estate, which are unique. The vast universe of commodities is typically divided into two major categories. Hard commodities. These are natural resources that must be mined or extracted from the earth. This category is further broken down into energy, like crude oil and natural gas, and metals like gold, silver, and copper. Soft commodities. These are agricultural products that are grown or raised. This includes grains, like wheat and corn, livestock, like cattle and hogs, and other crops like coffee, sugar, and cotton. These are not abstract financial instruments. They are the literal inputs of civilization. The price of oil dictates the cost of transportation and manufacturing. The price of copper dictates the cost of construction. The price of wheat dictates the price of food. But if these assets produce no dividends and generate no earnings, what is the fundamental force that drives their often brutal price cycles? The prices of all assets are determined by supply and demand. But in the world of commodities, these forces operate with a unique and violent twist: extreme inelasticity. Theory: inelasticity breeds volatility. In economics, inelasticity means that supply or demand does not change significantly in response to a change in price. Supply is inelastic in the short term. If the price of oil doubles tomorrow, we cannot instantly produce more. It takes years to explore, drill, and bring a new oil field online. If the price of corn spikes, a farmer cannot instantly grow another harvest. They must wait for the next planting season. Demand is also relatively inelastic. If the price of gasoline rises 10%, most people still need to drive to work. If the price of bread goes up, people still need to eat. This combination of a fixed short-term supply and a relatively fixed short-term demand creates an explosive environment. Any small, unexpected shock to either supply or demand can cause a massive, outsized move in the price. Analogy: the water well in the desert. Imagine a small desert town with a single well that can produce exactly 100 gallons of water per day. This is the town's inelastic supply. The town's population needs exactly 100 gallons per day to survive. This is its inelastic demand. The price is stable. A supply shock. One day, a pump malfunctions, and the well can only produce 90 gallons. The town still needs 100. The price of water does not simply rise 10%. It explodes. People will pay almost anything to avoid dehydration. A small deficit in a necessary good creates a panic. A demand shock. A group of tourists gets stranded in the town, and demand suddenly jumps to 110 gallons per day. The well can still only produce 100. Once again, the price skyrockets. This is the daily reality of the commodity markets: a geopolitical conflict in the Middle East, a drought in Brazil, a sudden economic boom in China. These are the pump malfunctions and the stranded tourists that create violent price swings. Example, oil versus gold. Different commodities respond to different shocks. Oil is the barometer of the economy. Its price is driven primarily by global economic growth, demand, and geopolitics, supply. When the global economy is expanding, demand for oil rises and its price tends to increase. This directly impacts global inflation and central bank decisions on loans and mortgage rates. Gold is the gauge of fear. Gold has very few industrial uses. Its value is almost entirely psychological. It is seen as a store of value when investors lose faith in traditional paper currencies. Demand for gold spikes during periods of high inflation, geopolitical crisis, or fears of currency debasement. It is often thought of as a form of financial insurance. Because of their unique nature, investors often make two critical mistakes when allocating capital to commodities. Pitfall number one, confusing the commodity with the company. Investing in a barrel of oil is not the same as investing in a company like ExxonMobil. Oil is a pure play on the price of the commodity. ExxonMobil is a complex operating business. Its stock price is influenced by the price of oil, but also by its management skill, refining margins, debt levels, and operational efficiency. They are fundamentally different investments. Pitfall number two, chasing long-term returns. As we saw in the intro, commodities are not productive assets. They do not create cash flow. Over very long periods, their real, inflation-adjusted returns tend to hover around zero. They are cyclical and speculative assets, not buy-and-hold compounding machines like high-quality stocks. Avoiding these fundamental misunderstandings is the first step to using commodities intelligently. But how do professionals use this asset class not for speculation, but as a strategic tool to enhance their overall portfolio? The advanced strategy, commodities as portfolio insurance. The most sophisticated use of commodities is not as a primary engine of growth, but as a small strategic allocation designed to protect a portfolio during one specific economic environment: unexpected, high inflation. A traditional investment portfolio of stocks and bonds is vulnerable to inflation. When inflation rises unexpectedly, central banks raise interest rates. This hurts bond prices directly. It also tends to hurt stock valuations, as future earnings are discounted at a higher rate. Commodities, however, are different. As the raw materials themselves, they are often the source of the inflation. Their prices are what is rising. Therefore, during an inflationary shock, commodities tend to have a low or even negative correlation to both stocks and bonds. The professional application is to allocate a small permanent 3% to 5% of a portfolio to a broad-based, diversified commodity index fund. For years, this allocation might be a drag on performance. But during a sudden inflationary event, like the one we saw in 2021 and 2022, that small sleeve can provide a powerful positive return that helps to offset losses elsewhere. It is not about timing the market. It is about holding a permanent allocation as a form of portfolio insurance. Let's distill this into the three essential truths about commodities. They are raw materials, not productive assets. Commodities are fungible, physical inputs. Their prices are driven by the often violent intersection of highly inelastic supply and demand. Different commodities have different drivers. Oil is a proxy for global economic growth and geopolitical risk. Gold is a proxy for fear, inflation, and the loss of faith in paper currency. Use them as strategic insurance. The advanced strategy is to use a small permanent allocation to a broad commodity index, not as a speculative bet, but as a strategic hedge against unexpected inflation, providing valuable protection for your traditional stock and bond portfolio. Commodities are not a path to steady wealth, but they are an indispensable tool for navigating a chaotic world. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.